Aishvarya Dadheech, who's also joining us from Ambit AMC. Aishwarya, uh, well, I'm not sure whether you've seen this, what has come about, but as a market participant, generally, you're not the F&O guy, I know it. You're more of a stock picker, especially in the mid and small cap side. But any thoughts on STT on options being increased? It will ensure that serious investors, the cult of serious investing actually gets a boost, right?
Thank you, Ajay. Good afternoon. Great to be on your show. I believe this like back-to-back two big events today. First, initially started with the debt fund when we saw what the new changes in the LTCG has been, and the recent one I think just breaking now right now. I believe the only important thing which government possibly is trying to do is to dissuade a lot of retail investors who are basically not really getting anywhere and possibly are at a higher risk on their capital. I believe that is the one possible reason which I can think of at this juncture of time. I believe there would be, better other reasons also, obviously, too. But I don't think it's not really going to make or increase the revenue by any from the government perspective. It is basically to bring some sanity about the unrelentless trading which were happening by people who are not very experienced. This is my understanding so far, Ajay.
I agree. This clearly, and we also saw that some of the brokerage companies, when they were giving out the listed ones, sharing the data every month, what kind of participation increase. Though there was a growth in participants, but the bigger growth was actually coming on F&O participants, and we all know that F&O is a product which you should only venture towards if you understand the game, the rules, the risks actually involved. So it is important to bring that for once. Now let's move forward and talk about markets. You tell us, mid cap, small cap is your area of expertise. Enough and attractive value. Are you getting spoiled a choice in picking additional names or not yet?
No, so if you really look at what happening globally, Ajay, I personally believe that, Federal Reserve has finally blinked, right? With all sort of last 2 weeks has been, I would say, nothing sort of unprecedented time where you've seen the 4 or 5 big banks completely went out of the window. And finally, the change of stance, like from ongoing to some additional hikes, is giving us one clear sign that we are toward the fag on the interest rate rally. And coming on to our broader market, there is only two things which is required, Ajay. First is growth, and another one is I would say, accommodative or a conducive interest rate environment. Right? It's very difficult to say whether Fed will start cutting rate later this calendar year or it will be the next calendar year starting. It will all depend on how inflation will pan out. But one thing is for sure that the field is getting set for a lot of these good quality companies, which to do much better over the next 2 to 3 years. So to answer your question short, we are really excited about the space. The valuations have really come down after the, pressure that we have seen in the market over the last 7, 8 months. FIs have been relentlessly selling India, right? We saw what happened in the month of Jan, for almost 3.6, $3.7 billion, followed by February number. Even in the month of March, we are seeing a number of $1.5 billion of inflow, but there is one big check which was issued by GQG, which is impacting those numbers. But if you look at the overall, I think India has been getting impacted sentimentally more. A lot of these European countries where the bigger problem lies in the growth, where the bigger problem lies in their banking system, most of their equity markets are possibly at all-time high. Look at FTSE, look at DAX. But India, possibly is the only market where a lot of these FIs are sitting on good amount of profits. India is slightly more expensive compared to, I wouldn't say slightly, they are definitely more expensive compared to various other countries. And that's why we believe this selling is happening. Going ahead, couple of months, I believe this volatility will here to stay, in your both broader as well as even in the frontline stock. But I believe it's a good time to go and pick high quality companies from that perspective. And if you really look at, this broader market has been underperforming the large caps. Look at the data of the last 3 years, 5 years, especially last 5 years, there's like 20% underperformance in spite of some good growth which we have witnessed in many of those names. So we are very, very bullish into that particular theme. We believe India is doing good. We believe earning growth is pretty resilient from that perspective. We believe we are at the fag end of the interest rate hike cycle. So it's a good time to go and start shopping, Ajay.
I wanted to talk to you about chemicals. Pii Industries, for example, 2, 3 back-to-back quarters of solid growth and solid guidance.
Yes.
Industry leader, but went through a good correction from 37 odd hundred to almost 28 for once, and now around 3,000. Big capex planned ahead. In fact, not only this one, Pi, other big companies also have lined up massive capex in chemical space, and the stocks have went through a good corrective phase. Is that an area you would like to add names or
Yeah,
look for value?
so that is like you beautifully have said that chemical have seen kind of a time correction as well as a lot of those valuation which went up to almost 35, 40 times 1 year forward are coming to more standard levels as of now. Businesses like PI Industries, which is sitting a good amount of cash, trying to look out for acquisitions or doing huge amount of capex. Look at Aarti Industries, very strong capex pipeline. Look at Deepak Nitrite and many other companies, in the chemical space, even smaller companies like what we own in our portfolio, like Neogen Chemicals, they have a very strong capex pipeline. Somewhere or the other, even the China plus one minus one is really getting, I would say, materialized from that perspective. And a lot of the valuations are now coming to 25 to 30, 32 times a level. So believe chemical as a space over the next 3 years should continue to do well, Ajay. And that is the reason we are holding a lot of good chemical names in our portfolio across, whether it is Ambit Good and Clean Mid Cap or Ambit Emerging Giant, which is small cap. We have a very healthy allocations to chemical as a space. But we are very very selective in the space because we want to stay with businesses with high earning growth. So as you said, higher capex intensity, where they've already done capex in the last 3 to 4 years, where they will convert into revenue and profits, is what is exciting us.
Home improvement companies like ceramic companies, Kajaria, etc., went through a very bad patch. Orient Bell and Somanis of the world, Cera. But it appears that the worst of their time is actually ending now. Would you take a relook at some of those names, because there are only 4, 5 of them, and there are 5% organized player in ceramic and faucet and that particular industry, and 95% is unorganized. So even
Unorganized.
next few years, if some more comes this side, at least the organized players' top line growth is assured and set for next 5, 7, 10 years.
Definitely, Ajay. And this is two themes which we are playing. One is the K-shaped recovery, which we call it, like, the shift from the unorganized to organized. And most important, the second part, which really get us a lot of confidence into businesses like this, is a moderation in the commodity prices, right? If you look at the last 9, 10 months, we have seen a steep decline in various commodity prices. Look at crude prices, look at palm oil prices, look at gas, right? Even on agri side and non-agri side, we have seen a massive correction in commodities. And what we understand so far that over the next 3 to 4 quarters, we are going to see a good amount of margin improvement. A lot of these companies were adversely impacted when commodity prices shoot up last 1.5, 2 years back, and they were we saw that kind of a dent in the margin that will start playing around. When your margin will start improving, at the same time the underlying growth on revenue is there. Our GDP is expected to grow, say, 6% for FY24. Even if you do 5.2, 5.4, 5.5, a lot of these companies will still able to grow 10%, 12% kind of a revenue growth. But because of this revival in margin, we believe they can still make 20% plus kind of impact growth for the next 2 years. And that's what we really like the whole space, whether it is FMCG. In our fund, we are trying to increase some allocation to consumer discretionary at this point. The reason being because of this moderation in commodity prices, which we expect to play out. So whether it is home building, whether it is, like you said, about tiles, whether it is FMCG, consumer discretionary, that are the segment, we are putting our money at work right now.
All right, Aishwarya. Today we'll have to keep it a bit truncated because of this breaking news, but we'll have you back one of these days, and we should chat up in detail.